All right, looks like we're at time. Hello, everyone, and thank you for joining us for the November edition of the Around the Valuation World International webcast. Before we get started, I wanted to go over a few housekeeping items. To earn CP credit for today's webcast, you will need to answer all the poll questions that pop up on your screen during the webcast. You'll receive a CPE certificate within 7 to 10 business days after today's webinar, and you can download that through the ncv.com website. That is if you have an AVW International subscription for CPE. If you have any questions during today's webinar, please use the Q&A option in Zoom to submit those questions to our presenter. If you have any questions about me, like technical questions or questions about NACVA, please feel free to use the chat feature, as those will be directed to me. Here are our technical editors. We have Wolfgang Nies with us today. We also, Andrew Newman and Pratik Shah are also our technical editors, and then Brian Jones is an advisor. Today, our lineup is, we'll just go over a few items for the GACP news section, and we'll turn the time over to Carla Nunes, who will discuss with us the Kroll Cost of Capital, a new beta module. All right. And really quickly, what I'm going to do is try to switch over to a quick little video for us. So hold on a moment. All right, and with that, I'm going to turn, Wolfgang, did you want to speak about the magazine for a minute? And then we'll turn it over to Carla. Oh, you were muted, Wolfgang.
Thank you, Chandler. Yeah, warm welcome from Germany to the rest of the world. We saw some snow in Park City. We had our conference in Germany for Europe in the beginning of November without any snow, but maybe next year we are a little bit later. So we are at the end of November, 1st of December in Berlin, and sometimes it might be possible to have snow in Berlin during the Christmas time. Yeah, I would like to draw your attention on one entry in the chat. If you would like to have a look at the European Business Valuation magazine, that's a new magazine we published since fall this year in English. Please feel free to download it, to share it in your community. It's for free, and the next edition will come up, yeah, end of December, maybe just a second before Christmas. I'm not 100% sure. So thank you for joining us today, and it's a pleasure for me to introduce Carla Nunes. She is Managing Director in the Office of Professional Practice of Kroll. She has over 25 years experience in that role. Carla provides firm-wide technical guidance in a variety of valuation, financial reporting, and tax issues. She's also co-author of Kroll's annual US and European Goodwill Impairment Study. She's global leader of Kroll's Valuation Digital Solution Group, and that's exactly the point why today she is with us. Kroll announced a new tool on beta calculation called Kroll Beta Module, and yeah, I'm happy that Carla is with us, and we can have a dive into the beta model. And yeah, let's have a look what happened. If everything is going to be more and more risky all over the world, what happened with the betas?
Thanks,
Okay.
Wolfgang. So I'm going to share my screen.
Yep.
And hold on. Oops. I'm okay. And let me just do one thing. All right.
Looks
Hopefully.
good.
All right, great.
Perfect.
So I was supposed to be talking today with my colleague Kevin Madden, but he's got the flu, so you're stuck with me for the next 40 to 50 minutes. So we're talking about a new beta module that we're introducing, and so this is just a sneak peek at some of the features we're going to show. And part of it is because beta, which often is like, oh, this is so easy, we've done it a long time, for a long time, what else is new, right? What we have found is that, and I'm going to skip what we have found is that just through experience, because I look at project teams, cost of capital computations a lot of times from across the globe, and I see over and over like people struggling with selecting the betas and what's the best way to select those betas. And we started thinking about, can we help with that selection? Can we provide tools that help the user to make that selection more in a more supportable way? And so so the point is that and through COVID, what we saw is that some of the betas have changed dramatically for some industries, which, by the way, had happened also during the global financial crisis of 2008, 2009. Now, I know that some people say they use the build-up method, so why do they need to care about beta? We will just show a slide to demonstrate that you still need to consider industry risk. And then we'll give you like a preview. So before we go there, just so remember, I just said that COVID-19 has an impact on betas. And what we're showing here is what Eurozone industry betas were at December 2019, so pre-COVID, and what they look like at March 31st, 2022. So just to see that, like, are some industries not really moving, and they're or are they moving significantly, and why? And this is based, by the way, they're regressed against MSCI Europe. And so so these companies, or these industries where we saw a big increase, and they're sorted, the difference is sorted by the smallest difference on top, which is pharmaceuticals. I mean, the most negative difference, and then on the bottom, the ones that saw the biggest positive difference from pre-COVID. And so on the pharmaceutical side, which is like the ones that dropped the most, we actually saw something similar for US betas as well, which is partly because the pharmaceuticals, with all the medicines to try to address COVID issues and the vaccines, etc., they stop moving as much with the overall market, and so that's why we saw a drop in the correlation with the overall market. And that actually happened in the US as well. Um, and now something that is very different in the US is the second item there is energy. That, it stayed like fairly flat, right? So it dropped by minus 0.06. And in the US, energy actually had seen the biggest increase. And part of it is because a lot of all of the turmoil so during COVID, the economy shut down, right? And so the demand for oil dropped dramatically, and some of the US energy companies got really impacted by that. And there was at one point the futures price reached a negative number for like first ever in history. And then there was a dramatic, as the economy started reopening, a dramatic increase in the prices of those companies in the West that are oil based. And so because of that dramatic back and forth in the US, and oil prices are priced against in the US dollar. So we saw this huge increase in betas in the US, and we're not seeing that here. Part of it is because also the composition of what energy companies are in the Eurozone versus in the US. The traditional oil and gas companies versus companies that are like electric power utilities that have both the energy component and the utility space. it so it makes it different in Europe than in the US. But that tells you something, right? It tells you that you have to be careful when you're selecting your comparable companies. And if they're like global players, are you truly a global player? And are these the true comparable companies for you? Or is this more of a localized market, in which case you want to use local comparable companies or guideline companies? So that just demonstrates the careful evaluation you need to make when you're looking at your subject companies. Now, the other part is the retail. You see, they're like both retail and software. They saw the biggest increase in betas after COVID. And retail, that's actually behaving similar to the US. And it makes sense, right? Because with all the shutdowns, retail operations were really subject to the economy reopening, and so they got more sensitive to what the overall stock markets were doing. And so that actually is a similar behavior in the US versus what we're seeing here for the Eurozone. Software, however, was not something we saw in the US compared to here. We're seeing like a 0.4, which is a big increase on software. And part of the reason is that if you look at the pre-COVID, betas were below 1 in the Eurozone. Well, that's not the case in the US. In the US, they're already above 1. So they moved a little further up, but not materially up. Also, let's face it, there's like a 20 to 25% of the overall market in the US is sort of made up of what we call telecommunications or communications and software. And so so they're moving more with those companies are more moving the market than here. But again, just to summarize, and by the way, these are all euro denominated returns to compute the beta, and that's something that people also don't often pay attention, which is one of the common mistakes I see when people um, look at betas from different countries and they're regressing against a certain index is the currency discrepancy. Sometimes people will not realize that the returns on the index might be, say, in US dollars, and the returns on a subject company might be in a different currency. And that actually changes the beta. So those are some of the things that we're going to try to, help the user with this new application. So for those who say like, well, I use a build-up method, like why do I care about betas? Because the build-up method, if you're doing this specification, you're looking at the risk-free rate plus equity risk premium plus an industry risk premium adjustment, which could be negative or positive. It's like an adjustment upwards or downwards depending on the risk of the industry relative to the overall market, plus potentially a size premium for some in some markets. This will be the formula used. Well, what is that? Oh, sorry. What is that industry risk premium? How is it calculated? So the industry risk premium, the way it's calculated, it's the formula down here below. It's like the beta of the industry times the equity risk premium that you selected minus an equity risk premium. In other words, what the industry risk premium is just an adjustment for what is really a beta, um, and converting into an additive instead of a product, a plus or minus adjustment to the overall equity risk premium. So for example, in the cost of capital navigator, for those who subscribe to the US module, and we have like industry risk premiums in there, and they used to be published by Morningstar and previously by Ibbotson Associates. But that's how they are computed. They're really just what are the betas for that particular industry and adjusted for a certain equity risk premium. So the point here is that even if you think that you're just using an industry risk premium adjustment, inherently implicit in that number, there's a beta. And so you do care about what are betas and how they're selected and how they're aggregated. So this is going to be, in terms of the tools, this is going to be like the fifth module that we're going to offer. So we have the US cost of capital, which is where those folks who use US size premium, for example, look at this and they look at the historical equity risk premium. We have, I'm going to flip here to the international cost of capital, which has country risk premium, international equity risk premium for developed markets, and some off-the-shelf betas. The US industry benchmarking and the international industry benchmarking, they're counterparts, and they aggregate betas into like industry aggregates. In addition to betas, there's like capital structure and industry WACC and industry cost of equities and some trading multiples like revenue and equity. But one of the things that over and over people would tell us as well, like it's like, well, I would like to be able to select my own group of companies instead of using these industry aggregates, which are aggregated based on GICS codes. So it's a global industry classification codes, and so that's what we're trying to do with this fifth module, the company level beta, where you'll be able to first start with a the input section, and this is we're still in the trying to finalize the development of this, so we're hoping that beginning of next year we launch it. But here you'd be able to select, besides the valuation date, one of the things we'll want to ask you is that what is the currency of the WACC? Because that's like the most commonly made mistake that we see from project teams and from outside and from clients, etc. Is people forget that the WACC has a certain currency associated with it. And so one of the things we're going to ask is like, okay, is the currency of the WACC, where is your company based? So that will help you select which market index you might want to select from. And the other thing relates to the betas, which is what is the return frequency that you want to use? Do you want to use weekly? Do you want to use monthly? And how far back do you want to go, which is the look back period? So here's an example how would fill this up. We could, say, okay, my company is based in Germany. The currency of my WAC is in euros, and I'm going to select MSCI Europe for my index. Now, why would you pick say Europe instead of like the local DAX? And this is like the kinds of decisions that people have to make. So more and more in an integrated market, companies are competing across jurisdictions. So if companies are, for example, like they're in Germany, but they're competing with France and Italy and Belgium, etc., really their peer group is in Europe, not just located in Germany. And so this is when you want to have like the type of exposure. That's an example of why you want to go a little bit broader in terms of trying to understand the sensitivity of that company to the overall market. The other thing we will, make sure one of the things we're still deciding on individual country indices that and we're using the MSCI family and indices, but like being careful about the following. There are certain markets that are not diversified enough. So what does that mean? The index might have like, 20, 30, 40 companies. I mean, the DAX went from 30 to 40 recently, for example, right? But if they're dominated by a single industry or by a single company, then any betas associated with that index are really not significant. They're not statistically significant to capture that underlying business risk of the company that you're dealing with. Because say, for example, if there's two companies, like I'm going to tell you, like, if you were looking at Saudi Arabia, you have like, 3 or 4 companies that just dominate. There's very few companies on the index. You have 3 or 4 companies that dominate the index. So any other company, regressed against that index is probably going to give you a beta that is really low. That means that there's no correlation with those companies, but that doesn't mean that they're not risky. So you want to make sure that the index is representative of the overall market and however those companies compete. So some of those are the things that we are trying to help the user with, and we'll have some explanations, some why you might want to go broader in some cases than just the country index. And in some cases, we won't even offer it because we won't think that it's relevant. I mean, it's not going to be statistically significant. So in this case, for example, we picked a 5-year monthly beta. You could pick weekly betas and for a different period. And also we're looking here how the index is performing graphically over a certain period. And then you'll have like a way of searching for companies. And so the list, here's an example. One of the things that, believe it or not, that people asked us to include is search by number of observations and tell us what the number of observations is. Because as an example, even though we might want to do like a 60-month beta, but what if the company had IPO'd, had gone public, and they're missing one period? And I still want to include it because I think it's a really good representation of underlying business risk. So that would be an example of why people said, like when we surveyed users, why they said they wanted to be able to search also by number of observations. We found out that ticker is not going to be a great way of searching because different systems have different tickers. So that ticker there, we're actually replacing with location. So you'd be able to search for a country or of either of headquarters or of incorporation. You can also search by industry. and by keyword. So you'll be able to try to match up the group of companies to your subject company. Now here, this is an example where, the companies will start populating. It would show the performance of the company that you selected against the index. You can graph that. What is not here yet, but what we're planning to add is a trailing beta. So first of all, there are various ways of computing betas. The most traditional is the OLS beta. So OLS beta being the the historical beta that you regress and captures the systematic risk against a certain index. But for companies, for example, that are thinly traded and they don't trade very frequently, a sum beta, which is that second line item there, is probably going to capture the risk better. So there's enough academic papers. One of them is by Elroy Dimson. It's called, and that's why sometimes the sum beta is called the Dimson beta, that showed that the betas for smaller stocks that were illiquid tended to have really low betas because, when the market moves today, they might not react until, say, a week later. And so because of that, what this sum beta does, or the Dimson beta, is that it captures that one period lag. So it's to capture that reaction. So not just the reaction to the market today, but the reaction from a week ago or from a month ago. And so for some of, if you're just dealing with large companies, this doesn't make sense because they're reacting immediately to the market news. But if you're dealing with small illiquid companies, looking at some betas may be, a better way to go. Another version we show there is the Vasicek adjusted beta. And what this is a forward-looking adjustment to try to reduce and this will compute automatically as you add more companies, which is when you look at companies that are that they have a standard error that is very high. In other words, there's like a lot of statistical noise. It's not really the regression is not explaining the returns of that company very well, and you might actually see a low R squared. What the Vasicek adjustment does, it's a formula that says, well, given the group of companies that we have, I'm going to give more weight to the ones that have a small standard error, so the ones that are more precise, and I'm going to give less weight to the ones that have a large standard error. So that's essentially what that formula does, and it's a way of making like that adjustment to be a more forward-looking beta. And so then there'll be like summary statistics, like what's the minimum, average, etc., as you add more companies to the mix. Now what is not here, as I said, is like one of the things that I find during like COVID, and was also true during the after the global financial crisis of 08 and 09, is that sometimes there's a significant break in risk. And I find it extremely helpful to look at, for example, if I'm looking at a 5-year beta, it's like 5-year monthly beta, to look at it over time. And sometimes you see like a marked change, like some companies are like their betas are going down consistently. Others are just keeping pretty much stable. Others see like a big break. And if I see a big break, I want to investigate. Like I want to know what are some of the things that happened with that company, say 2 years ago or 3 years ago, and is this a good reflection of what the betas are expected to be in the future as well? So an example during COVID, now that even if you're doing a 5-year beta, right now you're capturing 2.5 years of uh, information that it's during COVID, and some of the industries and some individual companies have moved dramatically. And if it wasn't during COVID, now they are, because of since 2000 and 2022, as interest rates are starting to go up, and then the exacerbation of inflation by the Russia invasion of Ukraine, we're seeing obviously inflation at levels that not seen for 40 years, and I mean in Germany for 70 years. So all of this has been having a dramatic impact on central banks' decisions to raise rates, and at a faster pace than was anticipated at December 2021. And what that has done is obviously, like a lot of market turmoil, and we've seen indices going down, but they're not, individual companies are not going down by the same factor. And that's why the beta, that's why it matters for betas, right? Like if they were going all by the same factor, then you just have the same betas. But this is again distorting, it's distorting like what betas look like. And some companies are down by more than 50%. So if we think about Netflix or Facebook, now called Meta, they're down by like 60-70% since the beginning of the year. I mean, that's dramatic. And so you have to be careful about the betas, and the beta period you pick, and whether going a 5-year beta might mitigate some of that if you think that there's going to be a bounce back. So that's something that we something to take into consideration. Another thing is, so we will provide beta statistics. So that's where I was saying, where we'll provide the standard error, and we'll provide like the t-stat, so the t-statistic, to see if something, and will indicate if something is statistically significant at a given level. And I think that would help the user say, well, this is not statistically significant and it hasn't been for a while. Maybe I shouldn't use the beta for this company. That's an example of why statistics might help. So it's not so much about just about the R square, because the R square, what's the power of the regression, the power, how much is explained by the regression of this company's returns. And the reality is that we know that CAPM is the capital asset pricing model, has its issues, like it doesn't fully explain the expected returns of a company. And in many instances, like if you look at we've done this analysis for like all US companies in that were publicly traded, and on average only 30% R square. Like the majority of companies only had like a 30% R square. But if the t-statistic, the actual coefficient of the beta coefficient, is statistically significant, then you should still be able to rely on it. So that's the kind of level of we're trying to help people say, well, why is this relevant, and why can this help you make a better decision? So that's an example of beta statistics that we will provide. Another thing that we will provide is unlevering beta inputs. So we will, you'll be able to unlever using the capital structure for those companies, but we'll provide you not just the Hamada formula, which is arguably the most used formula, the traditional way of unlevering betas, but also based on the author's names, the Harry Springle unlevering which methodology, which is arguably a superior method, because Hamada assumes that there's no risk with deductibility of interest expense. So what does that mean? It means like no matter how much debt you have in the capital structure, according to Hamada, you'll always be able to get full deduction of interest tax shields. Now, we know that's not true, right? If a company gets into distress or is like losing money, you can't deduct fully like all the interest expense that you are incurring. And so if the risk of actually being able to deduct those interest expenses in the period that they are incurred, a better formula to capture that risk is actually that Harris-Pringle. And Harris-Pringle requires something called debt betas because unlike Hamada, it actually says, oh, there is a certain level of risk related to this company if they're rated a certain, like by S&P or by Moody's, if they're rated, say, triple A versus double A versus on the A category. As you move down the rating scale, so triple A being the best, triple C being the worst, as you move down the rating scale, the debt beta actually starts being different from zero. And so that's what this, so that means that in a case of financial distress, the debt holders would also bear some of the risk if the company doesn't survive. And that model reflects more what the economic reality is. But again, it's up to the user. We're just trying to provide the tools for people to be able to unlever and relever betas with the appropriate data that makes the decisions superior. So so here's another example of, okay, here is, you would be able to see more or less all of the performance of the shares, the returns versus the overall index that you pull up, and you start seeing like having like different different companies added, different for the comparable company group, the peer group, and how the betas start moving along with that, like the statistics for average, median, etc. And so this is, I mean, more to come. In other words, we will our developers, our software developers are right now doing the, actually building the frames, the wireframes for the application. It's going well. We're still making some of these decisions on indices to include, etc. The first version that we'll introduce will not have all the features that we plan on having, just because we want people to be able to see something. But then throughout next year, we'll be adding some of these other features that we've been talking about. So I'm going to stop sharing, and I'm going to ask if there are any questions.
Oh.
Oh.
Any questions?
And while we wait for questions, Wolfgang, what have you seen like in terms of betas during COVID? Is this something that people talk about? Because I can also mention like some of the struggles that our project team had, for example, related to capital structure.
Yeah, we have we have a long list of challenges. As you might know, in Germany, it's very special. We don't use built-up methods, so we are very much focused on betas since years. And we see one effect relating on COVID, but also Ukraine, because these increasing systematic risk factors, COVID, now the Ukraine Russian conflict, inflation. These are all systematic risk factors. And what we see is that depending on the fixing of the market, is it a local market, a local CAPM or global CAPM? There is only one thing which is 100% sure, that the beta of the market is 1. And what we see is that if with these increasing systematic risks, lower betas increase, higher betas decrease, because everything is driven by more and more systematic risk, which moves the betas in the direction to 1. This is one effect we can observe here in Europe, but I think it's a worldwide effect. And the other thing is that, yes, there is a discussion in Europe, or especially in Germany, on these local CAPM or global CAPM use. This is not finally decided. But as you mentioned, a lot of analysts, they look at the market where the companies provide their services, and not from the theoretical point of view, from the investor's perspective. It's more on their revenue streams, and for large worldwide global players, it's more often used the global CAPM, and for these smaller, maybe companies only operate in Germany, maybe you will set your assumptions more on a local German CAPM basis. And we see one important point you already mentioned, that you need enough companies in your market. And only 20 or 30 companies might be not enough to get a reasonable result for a beta. And we can see it, for example, if you look at the Austrian market, there are only I think 20 companies in the index, but most of the index is only driven by 2 or 3 companies, so energy companies and banks. And yeah, there is a discussion about this, and if this comes up with reasonable results. So
and Wolfgang,
yes,
that's great, because that's exactly like in that situation, like I would say regressing against the Austria index alone would not really give you like the right beta for individual companies, because they're so driven by 2 or 3 companies. And that's exactly the issue. By definition, the CAPM is supposed to be a large group of diversified, a large diversified group of stocks, if you're not, as a proxy for the overall economy. And so that's the danger that you get into selecting these local country indices that are not representative enough of the risk that those companies face.
Yeah.
That's excellent. Like, sorry, to interrupt, but it was just like right on point with like the concern I've been having when I look at people regressing against like a small index locally.
But I've also, to be honest, I've also concerns about indices like MSCI World, because it is a US-driven index. It is not a global index. It is market value weighted. Most of the indices are market value weighted, so it's very much influenced by the heavy market capitalization companies. And yeah, so there are a lot of other choices of indices, but I see in our daily works that most of the people use standard indices like MSCI World or MSCI Europe or Stocks Europe indices, and most of these indices are market value weighted. So maybe we need some more research on this topic.
No, it's true, but there's also something that people don't realize from MSCI has, oh gosh, like so many indices, and what people actually call the global index is a misnomer. It's actually based on just developed countries,
Exactly.
whereas they have another index called All Country World Index, investable market index, where they actually have it's comprised of like 9,000 companies about that, and includes 24 emerging market countries. Now, you are correct that because they're market weighted, there will be a lot of weight to the alphabets and the apples, etc. But it's very different, I think, if you're looking at a market cap of 9,000 companies versus like 1,000 companies. So when we, for example, in this particular case for the beta module, we actually are going to focus on even though it's called, it's ACWI, All Country World Index, because we want to include not just developed but also developing or emerging markets in the mix, so to be truly a representative of a global index. So that's something that's a very well taken. The other thing I was going to say, in terms of like during this time of like your point about, and let me just share this again, your point about oops, always asks me twice if I want to share, if I really want to share. Yes, I do. So let's see, about everything going to the beta of 1. Well, it really, this is again MSCI Europe, so it's not global, but it's like all countries are based in Europe. And some industries saw like barely moved. They stayed where they were. Sorry, apologize. They stayed where, so telecommunications, for example, they really didn't change. Energy actually didn't change that much. That's why I was saying it's not just energy, it's energy plus utilities, so power providers. And now I thought it was interesting that indeed towards 1 is like food, beverage, and tobacco. And I think part of this was already starting to feel like food prices going up already in the tail end of 2021. And this is through March. So just at just after like the February invasion of Ukraine. But the food price volatility was already starting before 2022. And so it is interesting that the betas for food, beverage, and tobacco, but it's like mostly food and beverage, that they actually went up by a good amount, as well as autos actually became even riskier. And that to me was part of the global supply chain disruptions, because for a while, if with all the factory closures and all the the shortage of certain components to actually manufacture autos, and particularly the chips, like all the cars now are are like a big computer, right? So all of that supply chain disruption caused like a big shift here, and I would even say that like and insurance actually went up like the other way. It became like riskier, that more sensitive to the overall market, and I think part of that is also part of the losses related to COVID, because there were a lot of companies trying to get insurance claims for business disruption. I'm not sure how well that went and whether they actually paid these claims, but there was some of that going on. So yeah, so there is some move towards the market beta of 1 in some cases, but not in all cases. So and that's, I guess, where the professional judgment comes, right? Trying to analyze your subject company. That's
Yeah,
I,
yeah,
th-
sure, sure. It depends totally on the industry, and I made the same calculation as you showed this on this slide for airlines. And if you use monthly beta for December 2019, and then for the next quarter, you will see a jump of more than 50%. So
yeah.
and it's very similar in Asia, in US, in Europe. It's up from 1 to more than 1.5, the beta. Only
Yeah.
only three
3
data
months.
pointers. Yeah, only 3 months. And
Yeah.
that's
It's
impressive. Yeah,
it's incredible.
unbelievable.
Yeah.
Yeah,
I did see one more question here about like
exactly.
forward-looking adjustments.
Yeah.
And yes, so the what we were calling the Vasicek adjustment was like a shrinkage method. That's exactly. I was trying not to be too technical. But that's what that shrinkage method is. So it's trying to give more weight to the betas that have within the peer group that have a bigger that have a smaller standard error. So that's what that's called a shrinkage technique is. So definitely. Um, we are debating about the Bloom adjustment, and we probably will include it, but let me tell you about Bloom, which a lot of people don't realize. Because I actually read the paper, the original paper from 1971 from Marshall Bloom, but was a professor at Wharton. And when Bloomberg adjusts like betas to 2/3, 1/3, so 1/3 being the market beta of 1 that it converges to at a 1/3 pace, and then the 2/3 being like the actual historical beta for the company. Well, what Bloom did, Marshall Bloom did, is he looked at data from 1940s, 1950s, and part of 1960s, not all the way until the end of the decade. And what he did is he did rolling betas, like 7-year betas. He did it like, and he said, well, if I look at this different periods, what is the ratio by which they converge the following periods to the ratio of 1? And in some periods that he looked at, it was only at 0.2 ratio. In another case was 0.4. In another case, so it varied by the periods. And if you average all of the periods that he had, that's what you had about like 1/3, 2/3. It was actually not exactly 1/3. It was like 0.37 or something like that. But let's just so that and then he concluded by saying this can change in the future. This like rate by which it goes, like it will change. Well, turns out that here we are in 2022 using data from 1940s, 1950s, and 60s, and still saying that, well, the ratio by which a company should go to the market beta of 1 is 2/3, 1/3, and I have like a hard time being convinced that what the stock markets were back then versus what they are now are the same. And and even in his own data, it depended on which period he was looking, 5-7 year period that you were looking at, it actually varied quite a bit. So yes, it's a very crude adjustment. So there are some industries that will never go to 1, like in the United States, like utilities, which are regulated regulated companies, they never move as much as the market. So that's why I like the shrinkers technique better, like from Vasicek, because it takes into account your peer group of companies. But yes, so that's why I'm still debating about the whether or not we should include Bloom, although some people still want it, and and I mean, it's a very easy adjustment to make, 2/3, 1/3, and that's fine. But I have a little bit of a trouble conceptually of where those 2/3, 1/3 came from.
Yeah, it's I totally agree with you. But you also mentioned that it makes sense to have a look at the beta not only on the valuation date. So you have shown some graphs that it might be an interesting information where the 5 monthly versus 5 years monthly beta comes from, and how was the development in the past. And maybe if you see in the past, in the history, this shrinking, maybe industry or beta for companies starts 5 years ago with 1.9 and now it's 1.2. And you see this shrinking. Maybe this could be a reason to say, okay, let's go further to 1 and use Bloom better. But from an economic point of view, I think VASICHEK is much more defendable than Bloom.
Right, and I mean, that's a great a great point. And some of the things that I've honestly, some of the things that we're trying to do here is to make it was based on prior experience of finding it what is helpful in terms of when selecting betas, and so the example being like looking at how things have changed over time. So let me give you like a quick, and I know this is my own, it's you won't see this exactly in the let me just share this real quick. You won't see this in I think this one, all these calculations, but this is something I put together. At one point I was like, okay, how are things changing because of over time. And so this is like a 10-year trailing beta, and this is a US company. It's called but they have a lot of operations in Europe, for example, Harsco Corporation. And in this case, I would not really put much weight in the sum beta. I would look at the OLS because they're actually quite widely traded. But one of the things I wanted to know was, first, is the beta statistic significant, and like what is the t-stat over time? How much of the company is floated? Because one of the things that we find is that if the floating, how much of the company is actually traded in the market, makes a big difference. You might have a very low beta just because there's not a lot of trading going on. So that's something I like to see. And then I like to see like how things have changed over time. So oops, like I wanted to just show the graph here. In a and see, I can see that since 2012, the beta actually went all the way until 3 over here in 2017, and then came down a little, and since COVID it has come down a little, but it's more like to the around 2, which was what it was like back in 2012. But some other betas actually have a very different pattern. I just find looking at the trailing, like over the last 10 years, to be extremely helpful to see if there's something fundamental in the risk of the company that has changed versus other companies in the industry. So that's an example of of things that have helped me in the past that I'm hoping that it will help valuation professionals.
Yeah, thank you, Kara, and I totally agree, and I would like to recommend looking at the trading volume, at the liquidity of a stock, because that's what I've learned about the last 30 years, that the liquidity of a stock has a huge impact on movings and shrinkings and going ups. And if you compare such low liquidity stocks with the market, you will come up with a low beta, with low statistic, with poor statistic figures. So be careful with low liquid shares.
Yep.
Thank you, Carla. Thank you
All right.
to the audience for this excellent presentation and your dive into the new Kroll beta model. Yeah, the next, yeah, exactly. The next show will be on December 19th, and we will talk with Chris Mercer on some déjà vus he has with yeah, discounts and premiums. So thanks to Carla and thanks to you, and have a great Christmas time, and see you December 19th. Thank you.
Thanks so
Thanks,
much for
Chanda,
having me.
Bye. Bye, Chanda.
Bye.